And welcome to this latest episode of the Bull and the Bear podcast. I'm your host, Matt Clark. Again, as always, glad that you're with us on this holiday week. It's everyone's just getting all excited and antsy as Friday the markets are closed and basically it just leaves us today and tomorrow in trading and all that before we can kind of take a well-deserved 3-day vacation. It's been very hectic if you're like us and you watch the markets on a constant basis. I'm telling you what, it is enough to make your head spin. But before we get into that, just reminding everyone, as always, that you can catch the Bull and the Bear podcast on Apple Podcasts, on Google Podcasts, on Spotify, on iHeartRadio, and about 20 or so. I did kind of a count, about 20 or so different different podcast syndicators out there. So pick your poison, if you will, on how you want to listen to us, and any way you want to do that, that's great. Leave us a review, leave us a comment. We love that kind of feedback. Also, these are videoed as well. You can see our bright shining faces on YouTube. Just go to youtube.com and type in the Bull and the Bear podcast, and we'll be right there. And you can find us without any problem. You'll see podcast videos. You'll also see some educational content and some news videos as well that we try to put out on a regular basis. So I encourage you to do that, subscribe, and get notified every time we put something up. We're going to get more frequent with that as time goes on. But because this is the holiday week, I thought it would be good to change the tack just a little bit and really dig into America and what is American stock. Now, first off, let me preface by saying that most people who are seasoned investors would tell you that if you're buying a company just based on where it's located, that's probably not a good strategy. In fact, I think Adam has talked about that before, that it's not necessarily a good idea to do that because there are profitable companies that are located around the world that will provide you just as much in the way of gains and profit as any company here in the United States. It's not to say that you shouldn't. It's just to say that I wouldn't base your trading strategy on just where your company is based out of. Because there are a lot of companies that you can consider that are just strictly all American. You have natural gas companies that just have pipelines that move natural gas in the continental United States and even up to Alaska. But that's somewhat problematic now just because, of how that market is. Real estate, another truly all-American company that truly all-American sector that is, basically building, selling, and buying real estate in the United States. But for this for this instance, I wanted to kind of challenge both Money Markets contributor Charles Sizemore and Chief Investment Strategist Adam Odell. We'll bring them in here in just a second, and to look at 3 companies that you can consider all American because they are by and large American household names. But the difference between them and like natural gas or real estate is that they sell on a global scale in some cases. Or in other cases, they are a little bit more fluid in terms of what they provide than real estate or natural gas or oil or things like that. So first off, let me bring in Money Markets contributor Charles Sizemore from Texas. Welcome, sir. Thanks for being on here. And then also Money Markets Chief Investment Strategist Adam Odell, who's with us every week. Glad to have him as well. He's been. I tell you what, if there's a guy who's in more need of a 3-day vacation, more deserving of a 3-day vacation, it's got to be Adam Odell, because this guy's been working his tail off for the last I don't know how long. And so kudos to you, sir, to be able to take 3 days and enjoy that time. So, but first off, the first company I want to talk about is one that you see it probably every day. It's products you see every day, multiple times a day. As we get into the summer months and the 4th of July holiday, their products are probably going to be even more commonplace to see. And what I'm talking about is Coca-Cola. It's they have products that range anywhere from obviously Diet Coke, Coke Zero, Fanta, Sprite, Powerade, vitamin water. I mean, they run a gamut in terms of the product they provide. You're going to be stuffing your coolers or stuffing your fridge with their products on a regular basis, not only this weekend but through the summer. And this is a company that has been in the past a very strong hold to have, but in my perspective, probably more of a buy and hold type of a situation. But Charles, I want to get your take on this. I gave, just in full disclosure, I gave Adam and Charles this list yesterday. So they basically had a day to do some homework and look at
Wait, I'm not supposed to look surprised? I thought I was supposed to look surprised.
No, you don't know this. No, it's not game show surprise time. You didn't win a car or $1,000. You got paid today, so
well, if I'm not winning any prizes, I'm just going to leave.
Well, first I want to kind of get your take on a company like Coca-Cola and then dig a little deeper into your analysis on where you see this as, and what investors can do with it, whether they already own it or maybe looking at it as a potential investment.
Sure. There's a lot of layers here. First, there are a few companies in the world with the branding power of Coca-Cola. That the Coca-Cola sign is ubiquitous everywhere in the world, and people know what it is. I mean, it is, that brand itself has incredible equity. This is one of those classic Warren Buffett stocks. Buffett really abandoned value investing decades ago. People still think of Warren Buffett as a value investor, but he's really not. He's more of a growth at a reasonable price investor. He bought Coke. He likes to buy what he calls, great companies, excellent companies at reasonable prices. And Coke has been one of the largest positions in his portfolio literally for decades. And a lot of it comes down to branding. At the end of the day, they sell fizzy water. They sell actual bottled water. They sell liquids with electrolytes in it. I mean, they sell stuff that's exceptionally cheap to make, but they're able to charge a very nice premium on it because of the power of that brand. That is an all-American brand. It's all around the world. But when people see Coca-Cola, they say America, like this is America. Although, fun fact, do you care to guess what country in the world consumes more Coca-Cola, like just the original formula, Coca-Cola? What country of the world consumes the most per capita?
I'm going to guess either India or China.
Mexico, actually.
Really?
Yes, Mexico. It's funny. Our neighbor to the south really adopted. They copied the gringos when it comes to drinking Coca-Cola and took it to the next level. Per capita consumption of Coca-Cola in Mexico is they win the gold medal here. I believe we Americans get the silver medal. I'm actually not sure who gets the bronze, but yeah, fun fact. But yeah. Coca-Cola has been really beaten up, just like most of the rest of the market. The difference is Coca-Cola didn't recover as quickly. And one of the reasons is where do people consume soft drinks? And a lot of soft drink consumption happens in restaurants. And restaurants were, of course, locked down more or less nationwide. And even now, they're not at full capacity. Now, obviously, people buy Coca-Cola products for, they buy that, bottle of water, they buy a 2 liter of Coke, whatever. They buy that for their 4th of July picnic. Sure. They buy it for home consumption. But a lot of that consumption was taken offline. The restaurant consumption, if you will, was taken offline. And even things like airports, people that buy Coke at the airport. Yeah, it's just all those little incidental purchases have been dramatically reduced. And that's really weighed on the stock price. Now, you look at this, you say, okay, this will pass eventually. It may be several more months before it does, but accumulating shares of one of the greatest brands in history when it is substantially below its highs, not a bad strategy.
Okay. Adam Odell, I want to bring you in and get your thoughts as well. I think Charles rose some pretty good points, especially about the consumption points being significantly reduced because of the coronavirus. And that did weigh pretty heavily, not just on Coca-Cola, but also on the entire food and beverage, production industry. A downward turn of 20 to 25%. Between March and April, and that's a pretty significant drop. So Adam Odell, in terms of technical analysis, there are none better. So I want to have you come in and give me your take on Coca-Cola.
Sure, and I'll kind of frame how I do my analysis. And I like that you pointed out that you gave us a day to do our homework. And I just want to point out that what I do is I build systems. I build quantitative models that allow me to crunch a whole lot of data in the background in the computer, so to speak. And so that I can basically, you can give me any stock ticker and I can tell you within 5 to 10 seconds whether I would buy that stock, avoid it, or potentially sell it short. So I don't necessarily need a whole day to do homework on these types of stocks. I can look at my cycle 9 algorithm and within 5 seconds tell you whether I would buy it or sell it. I also built a 6-factor longer term investing model that basically ranks all the stocks in the universe based on 6 of the most fundamental driving factors that drive investment outperformance. So we're talking about momentum, the size factor, volatility, value, growth, and quality. So basically, I can punch in a ticker like Coca-Cola, KO, into my system and tell you right now within 5 seconds that I would not be buying Coca-Cola right now. As far as my cycle 9 algorithm, Coca-Cola is in a longer term downtrend. So we only buy stocks that are already trending higher. That's where you get market beating gains, and that's where you have safety of capital. Also, if you look at April, May, and June, when the market's been rallying, my cycle 9 indicator shows that the momentum in Coca-Cola has been less than the momentum of the S&P 500. So again, we're only buying stocks that are already trending higher in cycle 9 alert and with market beating momentum to a sufficient degree to give us a really high probability trade, like a 70% odds of success with that trade over a 2 to 3 month period. So on that note, Coca-Cola is not a buy for me according to my cycle 9 alert algorithm. Also, when I run it through my 6-factor longer term model, Coca-Cola ranks at about 45 to 50. So kind of in that middle pack. I mean, it could be a good long-term buy. Charles had a good point that it has great brand recognition and sells a cheap product with a good margin. You can actually see that in my rankings. It ranks high on quality. It actually ranks high on growth, which is interesting for an established large cap company like Coca-Cola. But as far as the value metrics, the momentum metrics, and the volatility metrics, it's really not worth buying at this moment in time. So I'd pass.
And I agree without even looking at your metrics. I looked at this and just kind of saw the typical chart of it, and it's just not, it doesn't speak to me. I mean, I think Charles is right. There is good brand recognition there. There is some potential, but in terms of right now, if you're buying and holding it, you probably want to go ahead and continue to hold it because it's a part of your long-term strategy. If you're looking to invest in Coca-Cola, now is probably not the time to do it. Now, moving on to the second of our three. This one, I pulled this one out and I thought, it's not only all-American, but it's really timely. This is a company that has been big in terms of entertainment, and that entertainment has now stretched around the world as its reach is global. And they have a recent product that has come out that has done extremely well, not just since its release, but even during the coronavirus pandemic, which has helped it offset what it's been lacking and in its probably most profitable side of the business, and that's theme parks. The company I'm referring to is the Walt Disney Company. That's on the New York Stock Exchange is DIS. And again, this is a very well-known company. It's been well-known for decades now. It started with Disneyland in California, cartoons and entertainment, and it just branched from there. The service that they just launched, I believe in November, was Disney Plus. It is a subscription service that has now garnered well over 50 million subscribers between Disney Plus and the bundle of Hulu and ESPN, which are also part of the Disney family. And in terms of media, I think this gets a little undersold a little bit, but in terms of media conglomerates, Disney is not small. When you tack on ESPN, you tack on Hulu, you tack on all the different channels involved with Disney, its media side is extremely strong. But it makes its money on theme parks. That's where a bulk of its revenue comes from. And when you close those down, as they've been closed down in China, in France, and here in the United States, that is a huge blow to the bottom line. And I think that's been relatively evident. So I'll start with Charles and kind of get his take on Disney and what he sees with Disney. Charles.
It's funny. We talked about brand equity with Coca-Cola. I would say Disney is right up there in those top 5 most recognizable brands. And when you see that outline of the castle, the Snow White castle or whatever, and the Mickey Mouse ears, that ranks right up there with the McDonald's golden arches, the Coca-Cola, red emblem. These are the elite of the elite in terms of brand recognition, which is a big reason why Disney is able to charge a premium for everything. If you've ever been to Disney World, you know what I mean about that. Now, obviously with Disney, there's a lot of short-term risk. There's a lot of headline risk. Their businesses have gotten just bludgeoned from all sides. The theme parks are effectively shut down. I mean, even if they reopen, is there a Disney park open at full capacity anywhere in the world right now? I don't believe so.
No, I believe the closest one that's been open is the one in Shanghai, but it is even at a capacity. It's capped in terms of what they're allowing.
Yeah. Yeah, so that's just the theme parks. I mean, but beyond that, there's the movie business, which is also effectively on hold. Disney had to yank several fairly large movie titles from. They had to push the release date into the future by months. I mean, that's just revenue they'll never get back.
Mulan, the live action Mulan is the one that generates a lot of the headlines because it was supposed to be released in June. It was pushed to July. And now just as of yesterday or the day before, that's been pushed back even farther.
Sure.
Not that filming's done. It's just why release it when it's
there's no going to watch it. There's no point. And Black Widow, the Marvel franchise, that's also been postponed indefinitely. So and then in like that final just left punch, right punch, and one more punch to the face here. The sports business is also suffering. ESPN is not making as much money as they normally would because there's very little in the way of live sports. Now that's changing, but at least for the last several months, there's been really. I think I was watching Korean baseball for lack of anything else to watch because that was literally.
Interestingly enough, that has been their staple of live sports because it's the only thing on.
There's nothing else.
They are showing it, and it actually does well. The issue that ESPN has is the time difference. Korean baseball is played at nighttime in Korea, which makes it at a very bad hour in the U.S. to watch it live.
There is never a bad hour to watch live sports. I don't know what you're talking about.
That's true, but I mean, I don't know if you want to wake up at 2 or 3 o'clock in the morning to watch a Korean baseball game.
Well, when you're desperate enough for sports, you will. But so all of that's sort of the bear case on Disney. Like all of the risk that is very obvious and out there. I'm not saying anything that's not very obvious. Where Disney gets interesting is if you look at the market cap of Disney and you compare it to the market cap of Netflix, they're about the same. It changes day by day, of course, but they're within rounding error of each other. Now, I take the view that Disney Plus, the Disney Plus streaming app, is every bit as valuable as Netflix. At the end of the day, pretty much everybody in the entire world wants. It's not available everywhere in the world yet, but it's getting there. Just like Netflix, it had to be rolled out country by country. Every parent with a child from the age of 0 to 12 is, or even older, is going to buy the Disney app. They are. They're just, you can't not buy it if you have children. It's really just that simple. The total number of subscribers for Disney Plus, I expect will surpass Netflix in the not too distant future. I mean, it might take them a year, it might take them 2 years, but I expect the Disney app, and not even including Hulu and ESPN and all that, just the regular bare bones Disney Plus, I expect that to exceed Netflix in terms of subscribers. Now, by that rationale, and given the fact that Disney pays less for its content than Netflix does, because a lot of their content is existing stuff they already own, whereas Netflix has to license all of its content, Disney has natural profitability advantages over Netflix. And that's a structural advantage that will never change. Netflix does not have 100 years of history the way that Disney does, and a huge catalog of content. It's my view that Disney Plus app, if that were a standalone stock, that should be worth as much as Netflix by itself. By itself, that should. So if you're looking at Disney stock price, you're effectively getting the theme parks, the movie business, ESPN. You're getting all that other stuff for free. So I think Disney's a very compelling long-term buy. I would like Adam's take on what the short-term technicals look like, but I would say as a long-term buy, one of those stocks that if you are going to buy something and drop it in a drawer for a few years and not look at it, this would make the short list.
And let me back up a little bit. I need to make sure I'm correct here. As of May 5th, there are 54.5 million Disney Plus subscribers. If you add Hulu and ESPN, that number is around 97 million. And just to put that into context, the number of subscribers that Netflix has is about 182 million. So when you talk about Disney surpassing Netflix, I
It'll
think
take a while.
It'll take some
They'll
time.
get there.
But if you toss in Hulu and ESPN, which they put together in a nice bundle, full disclosure, I have it myself. I also have Netflix. But I think that timing of that entire 3 network grouping surpassing Netflix is probably might be a little closer than you think, depending on how long we stay in this virus mode and things like that. Now, I agree. I do want to hear Adam's take on the technical side in terms of Disney. So, Adam, I'll turn it over to you. And now that you told me that you only need 5 seconds, I'm not giving you a day next time. I'm just going to shoot them right at you. And you're not going to get any lead time on these from now on.
Send them my way. So first of all, I'll say I do think that Disney is a very interesting case in the sense that their core business, what they've known for and what they've built their assets up to, is based on in-person experiences where you have to be touching the rides and you have to be around people and everything. And so that obviously from a story headline perspective is a headline risk in the age of COVID. And you can actually see that, like if you look at my Cycle 9 momentum indicator, Disney was actually outperforming the S&P 500 through May and June. Now, the reason it never triggered a buy signal, according to my Cycle 9 algorithm, is that the stock was in a downtrend. So I think what that is a case of, investors kind of got excited about the reopening. And Memorial Day came. We got bored with the quarantine. We decided to go out and party at the Ozarks like you saw in the news. And so basically, everybody thought, all right, we're back to business. Disney's going to, snap back. Disney was down 45% from its highs in late 2019 to its March lows. I mean, the idea that you cannot lose half of your money in a large established blue chip stock like Disney is not, it's crazy. It's not true. You can lose that much money. But I think this is a case where investors kind of got ahead of themselves and thought, all right, Disney's going to snap back. It's down almost 50%. It's going to rocket higher, and maybe we got a little bit ahead of ourselves when we realized, all right, well, maybe it's not back to business 110% like we thought. The virus is still out there. We still have some concerns. Capacity is not going to be 100%. Whatnot. And in fact, what you saw is that, despite that market-beating momentum in Disney, the stock was not in an uptrend. It was still below its 200-day average. And in fact, like about 3 weeks ago, it traded up to its 200-day moving average, which was at about at $125 per share. And as soon as it hit that level of resistance, it fell back down to under $110 a share. So, one thing I'll make a note about this is I always say we only buy stocks that are already trending higher. Using a trend filter, even if it's as simple as the 200-day moving average. I talk about this all the time in my service, Green Zone Fortunes. Even if you use a simple trend filter like the 200-day moving average, if you are in a position long, if you're holding a stock and that stock falls into a downtrend, whether it's under the 200-day moving average or whatever other measure you use, sell the stock. Go ahead and cut your losses short so that you don't suffer for that full 45% drop like Disney went through. If you had bought at the worst time to buy Disney in 2019, which was at its highs in December, if you had bought up at $150 a share, and just bad timing, 2 months later, COVID strikes. If you had just sold the stock when it fell under its 200-day moving average, you would have lost 8%. Now, 8% is not anything when you compare it to the 45 drop that it went through. So again, if you're using a simple trend filter, you can use it not only to get into stocks that are already trending higher, but you can use it to sell stocks like a trailing stop, more or less, if you already own a stock and it starts to drift lower. So that would be my piece on Disney. Right now, it's not a buy for me. I'd wait for the uptrend to reestablish, and then I'd look for a better momentum signal.
And I agree. Saying that I just, and not looking at Adam's data, just in looking at just the chart, it's not, I think long-term perhaps yes, but in terms of a short-term buy, I would probably pass on it until you see some indicators change in a more positive light for Disney. Now, the last company that we'll get into, and we'll try to tackle this briefly. This is one that may not necessarily be as widely known as others, but I picked it because it is a brand. It is a good sized brand. It's a company that is not just recognized under its own name, but also has several other names that is kind of subsidiary of it. And I think in terms of looking at it for the summer and especially the 4th of July weekend, I think it's good to do some analysis on it. And the third stock I have here is Kroger Company, that is on the New York Stock Exchange as KR. It is one of the largest grocers in the U.S. In fact, I think might be the second or third largest in the U.S. It's got about 2,800 supermarkets in 35 states. So it's got a wide footprint here in the United States, but it also has 24 different, what they call banners. And it's not just a Kroger store. It may be named something else, but it is a Kroger. It's owned by Kroger. And obviously, as we near the weekend, grocery stores are going to start getting packed with people buying, various items to cook out with, or whatever your plans happen to be. You're going to the grocery store to buy those items. And Kroger, if you're in one of these 35 states, odds are Kroger's going to be one you're going to go to. So Charles, first, I also picked this for another reason, and I want to see if either of you two get on that reason here in the next few minutes. Charles, briefly, give me your thoughts on Kroger.
Sure. So Kroger, I think that short-term narrative of, hey, people are still going to be eating at home more, they're going to be going out less, that should benefit grocery stocks in general. I think there's not a lot of short-term risk in this stock. I think if you are looking to allocate somewhere fairly safe for the next several months, this is definitely a decent option. Now, that said, be careful. The elephant in the room for anything related to groceries right now is Amazon. Amazon.com has, of course, they bought Whole Foods a couple of years ago, and they've really expanded their grocery delivery business. I know I'm fairly middle of the road when it comes to my fear level of the virus. I'm mostly just kind of, hey, I'm wearing a mask or whatever, but I'm not panicking, right? Well, my poor wife, she really is just like scared to death of leaving the house pretty much because the case counts are rising. So she's started buying most of our groceries on Amazon, and they just show up on our front porch. We just open the door and, oh, hey, the week's groceries are right there. Once you get used to that kind of convenience, are you ever going to go back to the grocery store? Not even if there's no risk that, the whole pandemic thing is over. It's just, but the groceries just show up. I just click a few buttons on the mouse and the groceries just show up at my front door. Like, how can you beat that for convenience? Now, Kroger has been, they're not, they know that this threat exists. They've been trying to counter it. Now, Kroger will deliver groceries to your car and whatnot, and they're working on home delivery options of their own, and they're fighting this fight. But do you want to fight Amazon? How many companies can credibly say they fought Amazon and won?
Very few, if any.
If it's like I fought the law and the law won, it's like there may be a country song someday. I fought Amazon and Amazon won. So I would say Kroger might be a decent short to medium term buy. I wouldn't fall in love with it though. I would be very careful with this as a long term holding.
Okay, Adam, your thoughts on Kroger?
Well, I have a different take. First of all, I think it's a good short-term buy and a good long-term buy. I'll say that right out the gate. I did, in my Cycle 9 Alert service, recommend a grocery store stock just a few months ago. We got into Sprouts Farmers Market. I can reveal that here because we've already out of the trade. We closed that trade for like a 60-some% profit, trading options on it over like a two and a half month period. So, right now, the short-term, the headline risk is not there. Grocery stores are essential businesses. They have either the same or increased demand, whereas a lot of other businesses are suffering decreased demand. So that's obviously fits the story. But Kroger stock is trending higher. It's been in an uptrend the whole time, even throughout the crisis. It's hitting new all-time highs right now as we speak. Its momentum relative to the S&P 500 is better. So forward looking over the next 2 to 3 months, Kroger is a good buy. But even more importantly, I think it's interesting. I have a love-hate relationship with Amazon. I order tons of stuff through Amazon. Once you get used to that, you definitely get used to that.
I don't think you're the only one who has a love-hate relationship with a company like Amazon. Really, I don't think you're alone in that.
Fair enough. But even when I wrote up the buy recommendation for Sprouts Farmers Market, I explained, they're using Instacart or they're starting to build their own systems internally where they can offer grocery delivery, a curbside pickup. So that's going to, and it is profitable. Sprouts' delivery model is profitable. It's not a loss leader, it's for them. And I would imagine Kroger's the same way. So I think that just because Amazon is able to deliver groceries to your door doesn't mean that these other grocers are going to go out of business. I get annoyed when I get Instacart shipments and they leave them on the door, and they bought all the apples that have spots or big dents in them, or they bought something that expires tomorrow, and I would have known to buy something that expires 2 weeks from now. So there's certainly some annoyances with that, but long term, I think the grocery business is going to be robust to disruptions like this. The other thing I want to lean on in my analysis here is that in my buy recommendation long term is that I ran Kroger through my 6-factor long-term investing stock ranking model. It ranks 97.7 as a total overall score. The only thing it ranks lowly on is the size factor, and that's because it's a big company, just like Amazon. Charles, I'll throw a jab at you. You're a value guy. You're a value investor, but get this. Kroger ranks 95 among all the stocks in the entire universe on value, meaning that there are only 5% of stocks that are a better value than Kroger right now. Amazon, on the other hand, ranks 14, meaning that 86% of stocks are a better value according to valuation metrics than Amazon. So for me, love, hate Amazon. I'd rather buy Kroger at this point.
And I know that there are some inroads with Amazon, and trying to tackle Amazon is a tough ask. But I still think that shopping habits change. But I don't know that in terms of groceries. I think that's a different type of habit you have to adjust. Buying clothes online or buying other things like that online is one thing. Buying groceries that have shelf life or that require a little more instantaneous purchase, I just don't see that. I mean, I think there's going to be home delivery, things like that. I think are going to pick up, but I just don't know that Amazon really hits companies like Kroger all that hard in that respect. And that's just my take. That's just my take.
What's interesting is when Amazon bought Whole Foods, one of the stocks that got beaten up the most that day was Kroger. I mean, Kroger's stock price caved because of that fear of oh boy, here we go. Like Amazon's getting into groceries, everyone else is toast. Now, the reality ended up not being that bad. Kroger has proven to be resilient, and one of the reasons that Kroger has done well and is in such a good uptrend is it started from a low base. After, once the dust settled, Kroger stock had fallen. It was cheap, and as Adam pointed out, it's still cheap. So that's that created a very good buying opportunity for the value hunters there. I agree. It's not like everybody goes to online grocery ordering forever, but at the same sense, those changes do happen at the margin, and at this point, I think they are going to be fairly sticky. So I think it may boil down to 5 years from now, which of these grocers just did a better job of adapting to modern trends. And Kroger is definitely a worthy competitor. I would rather bet on Kroger than on a smaller chain that doesn't have Kroger's deep pockets to build out the delivery infrastructure. So I would say, yeah, I mean, Kroger, if you're going to bet on somebody other than Amazon, Kroger's a decent bet.
It just sounds like you're hedging because of what Adam brought to the table. Is what that sounds.
Well, no,
like.
You don't have to be. Look, I even though Amazon's expensive, Amazon's been expensive forever. I own some Amazon. I'll probably just hold it forever. Well, forever is a long word, of course, but forever is a long time. But I think you don't have to buy. You don't have to do either or. I mean, you can buy both. I mean, there can be a compelling reason to buy both.
I'm with that. I like Kroger. I like Kroger for short term. I like them for a long term. I think I think they're going to come out of this coronavirus stronger. I think they're going to adapt, their business model somewhat to include home delivery, maybe online to a certain extent. But I think Kroger comes out of this looking pretty good. Probably even better than they do now. So those are the three that we want to get into. And I appreciate the time that Money Markets Chief Investment Strategist Adam O'Dell and contributor Charles Sizemore brought to the conversation. I want to try to do something a little compelling that had kind of an all-American 4th of July tune to it. And you guys knocked it out of the park, and I appreciate that. Just as a programming note, we will not have a podcast on Friday because we will be taking in the 4th of July holiday with our respective families. And we certainly wish everyone who is either off or working to have a very safe and great 4th of July weekend. So, guys, I appreciate the time. Thanks for coming on. For Charles Sizemore And Adam O'Dell, I'm Matt Clark. Check us out on Apple Podcasts, Google Podcasts, Spotify, iHeartRadio, YouTube. You can get us at a variety of different places. And I'll obviously check back with moneymarkets.com on a daily basis. We've got new stuff coming up on there every day. So again, guys, have a great 4th of July weekend, and we will be back on next week.